Hello guys, welcome to another episode of Money Talks with me, HJG White from eToro. Now, despite this being a slightly simpler video for me to make, in theory, it has taken me a while to get this all set up with the screen recording. It sounds like such simple stuff, but it's been a right faff. But anyway, the concept of this video is I'm going to be going through your comments, and just so you're aware, this is how your comments appear to me. And in the entire history of this channel, I've had 125,000 views, and as of right now I have only 6 comments that I have not gotten back to. So yeah, if you leave a comment on my videos, I will respond to it. And in one of my recent videos, on one of my Warner Brother Discovery videos, I said if you comment on it with your stock positions that you'd like me to do research on, that I will do research on them. So without further ado, let's get into the video. Okay, so the first comment is on JD and Baidu, and there are also comments, I believe, on PDD, all Chinese stocks. So we're going to get into all of these all at the same time. I understand JD, so this is all I understand about JD before we get into it. I know it's a Chinese company. I know that they sell sort of sportswear. So again, I like to log into Simply Wall Street and also another site called Finance Charts. JD.com. Right. Okay. And the first thing that I'm kind of interested in is seeing the gross margins. And wow, this year they had an 8.7% gross margin. And that I don't like to see. So what you want to see is a low cost of sales and an extremely high gross margin. I mean, a fantastic gross margin is like 70-80%. And it's quite unbelievable that some companies have that. Some big companies. And so what did they have in the past? Wow, 7% gross margin. By the way, I'm looking at this for the first time, and this is the first thing that I went to. And I know that China was doing better in like 2016, but their gross profit margin was 7.2. So that's the first thing that I'm not too happy about. Okay, so a lot of people are saying that JD are growing faster. Let's just have a look at their financial health, their past performance. I just want to see their growth. Whoa, explosive revenue growth. That's fantastic. And potentially a lot of, the thing is, it's hard to tell what I would need to do research on this stock with if I was going to do lots of research, was how much of that is secretly development costs. Because what they're saying here is their expensive on research and development is 23% of their like expenses. But I'm curious to know if their cost of sales, if that has like purchasing of warehouses or anything like that in it. But if that's just the cost of the products, that's one of the downsides of being an e-commerce giant with all this competition around. And it seems like they have let their margins slip for the sake of growth, which is not, that shows to me a lack of competitive advantage. I just want to show what I'd compare it to, the company that I'm really familiar with, just made a video on it, Alibaba. And so Alibaba is having a really tough time right now, being really beaten by COVID and all these other things, and China aren't having the best time. But I know from past experience, look, we'll take a look at this. This year have a 35% gross margin, and out of that they have a 20% gross profit margin out of the gross profit. And all of this stuff is money that is being poured back into the business. So I mean, not all of it, but there's a lot of investment going on in Alibaba to try and become the delivery part of the online retail space. And if you have high gross margins like they do, then it's easier to invest in new businesses. And by the way, that's 34%. And as we went back through JD, their profit margins weren't any higher in history. Alibaba had 46% gross profit margins in 2019. They did pretty well at holding this throughout COVID. Look at that, 35%. Back in 2017, 60% margins, 62% margins. And then we don't have data in 2015, 70% margins in 2014. And so that's a huge difference in competitive advantage. And today, it still seems like Alibaba have a competitive advantage over JD.com. The next thing I'd look at for JD.com, just so you guys can see the other things, because that's probably where I'd stop looking for JD, because gross profit margins is such a big deal. And they have these two have such similar growth curves. Like when you go to see Alibaba's growth here, huge growth, and then the growth slows down, but it's still pretty good. Like you're seeing in 2023, 2024, you are seeing it pick up. When you go to the past performance here, you've got the exact same curve. So what we're sort of witnessing is China just growing, economic development going really well in China. And these two are sort of mimicking each other. What I could do is I could go onto finance charts. I could just look at, I want to see something like their 5-year compound annual growth rate. And that will be in the discount 5-year. I'd actually prefer to see their 10-year compound annual growth rate. So free cash flow, so that's a good, free cash flow is the money spent, the money earned before spending it on things like share buybacks and paying down debt early. Neither of these companies have very much debt at all, which is really great. So JD has a 20% almost 5-year compound annual growth rate. Doesn't have the 10-year in here. Would love to see, here we go. Free cash flow compound annual growth rate chart. Their 10-year is 33%, which is incredible. Okay, if it had a higher compound annual growth rate than that, I simply wouldn't expect JD or any company to. 20% is probably what I would expect from this stock, because when you've grown big, when you've grown a lot, like a tree that has grown an extraordinary amount, always has its slowest growth right after its biggest growth. So all I'm trying to say is that eventually growth slows down. You shouldn't be pricing in the same growth as last year. Just because it grew that much last year is just as much reason that it will grow less this year. Anyway, let's just have a look. So we got 33.85% on JD, and then comparing it to Alibaba. Growth rate. And so we go down to the compound annual growth rate chart, and their 10 years 8.2. Okay. So, that's their net income. Where's their free cash flow? Free cash flow, 17%. Okay. Interesting. I wonder why that is. 10-year, very volatile. And it looks like they're going, well, I know that Alibaba are going into an investment phase, but that is something worth noting. I mean, that really is impressive, isn't it? If that can continue, then this is a fantastic stock and potentially better than Alibaba. But the thing that does make me nervous, the stability of that, right, is built on margins. There's a bit of stability built into the fact that China do not allow much competition. So basically, you know that a US company isn't going to come in and undercut them. But there is an issue of, like, if people are wondering whether Alibaba is, or if JD is better than Alibaba, Alibaba can drop prices a ton, because they have about 35% more profit in their pricing than JD. So JD have 7% profit in their pricing. Alibaba have 35% profit in their pricing. So Alibaba can just bring down prices if they really want to. But this free cash flow growth is fantastic. But potentially they have paid a lot for this growth. Anyway, I think that's enough on JD and on their free cash flow. I just want to show you guys their financial health. We're on JD again. One of the things I love about Chinese companies, and one of the reasons that they're so safe, is that they just have so little debt. This is actually high amount of debt for a Chinese company. Again, let's just go to Alibaba, their financial health, down to their, about similar. So a 19% debt to equity ratio. JD has a 22%. debt to equity ratio. Both very, very small. You scroll up, you'll see that they have loads of cash relative to... So you got just in cash 201 billion Chinese yuan, and their debt is 62 billion Chinese yuan. You do have liabilities and stuff like that to look out for, but yeah, they have just so much cash, they're fine. So because that stock wasn't, to me, enormously better than Alibaba from a financials point of view, it didn't merit for me going through their entire story. Particularly, I just really want margins higher than 7%. If they'd had high margins in the past, I would have been curious to see how they could go back up to having those high margins, but they haven't had them in the past. If they begin to grow, then it would become more interesting to me. Right, the next one that Chris491 wanted was Baidu. Here we are. 51% margins on Baidu in 2024. 51% 2023, 48%. So growing margins. Whoa. Pretty consistently 50 to 55, 65, 70% margins, similar to Alibaba in 2013. That is incredible. I don't actually know what Baidu do. Slightly inconsistent free cash flow, but that's absolutely fine. The free cash flow is good, and the earnings are, that's just them spending the money. So there's going to be more volatility in earnings, and you can see when they don't spend much money, those earnings start to shoot up. And pretty steady, bumps in in revenue growth. So I'd be interested to know how they're growing the business. Pretty meaty depreciation and amortization cost there. So we're going to look at the financial health. They certainly use more debt than the two other Chinese companies that we just looked at. 27% debt to equity ratio, but again, it poses no risk. And the way that this business is growing, it seems like they're using debt in a fairly reasonable way. Okay, so what is the price to earnings? Now I start to look at the price to earnings because I'm intrigued. A P ratio of 10. Guys, if this stock was in America, that PE ratio would be 30. Easily, hands down, right now, that PE ratio would be 30. Just based on those margins, those 50 to 70% margins. Right, let's have a look at their actual free cash flow growth over the past 10 years. That is it's insane. It is insane how cheap China is right now. Guys, I've done videos on Taiwan and China and all of these things. Go watch my latest video, Value Trap, if you want more of my thoughts on that. I'm not going to get into it in this video, but basically, you can't say that this Chinese stocks are cheap for any reason that existed back when the stock was booming and had a really high multiple. If that reasoning existed back when the price was high, that isn't the reason the share price is down today. God, price to earning of 10 for a stock like this. This is interesting. This is more interesting to me than JD. So Baidu net income chart. We saw that was really bumpy, but that's fine. Where's that free cash flow chart? That's more interesting to me. Free cash flow. And that's the free cash flow. Oh, okay. I thought that was a net income chart. Did I just look at that? Oh, that's down there. So, okay. So they didn't have free cash flow in 2016, it seems. And then it ballooned 190%. 15-year. Very, very good. Very, very good. Okay, I'm interested in Baidu. Okay. That's one that we might do more on. Baidu. So, by the way, that's just, we're going to pause on Baidu for now because I feel like I will need to do a deeper dive. And what I would be doing next is looking at where they were 10 years ago, how they grew to their size today, and then what they're going to do in the next 10 years. What are the CEOs now looking to do? But for now, let's just move on. Let's just do these quick financials. So far, it's a no to JD. It's a difficult no for JD, but I think Alibaba is still more interesting to me. Baidu is intriguing, and so I'm going to just do more research. Sorry if I'm rambling, guys. Love your videos. Thank you very much. My recommendation is Watches of Switzerland. WOSG is a luxury watches retailer in Europe and US. Last year, Rolex bought Boucherer, the competitor, because of fears possible supply problems of Rolex. Rolex prioritizing over WOSG. The stock completely nosedived. I think the current price is a steal. Hope you like the recommendation. Right, okay, so this is exactly what I wanted, was a bit of a theory as to why they believe the share price is nosedived. I like a story behind a stock. It's definitely a risk to this brand, and that Rolex have bought out this company. But potentially Rolex just want exposure to the competition and they don't want to harpoon the competition. I can't imagine that they would spend so much on a new business and then not want that new business to thrive. A lot of people think that people buy things to kill things. Typically they buy them just hoping to get in on the action and just offset their risk. So let's have a look at Rolex. WOSG, I believe it is. WOSG. I've also been seeing videos about how people no longer like Rolex anymore, and that seen watch review guys talking about how Rolex are overrated, which I kind of thought was the point. I always thought that they were a bit of a status symbol. I didn't really know. I didn't know if the watches were that good or not. I always assumed that people could build better mechanisms, but I don't know. I don't know much about watches. I've never really cared about them. So WOSG, so starting with 12% margin this year, 13 last year, 14. So they have lost a bit of margin in recent years, but they gained 9.1. And look, this is the cost of sales here. This is the real fundamental thing. This is the money they have to spend every year. And then this is the profit they make of it. 20%, 16%. The highest they've ever gone is to 20%. So this is quite reflective of fast fashion and the competitive industry that they sit in. And so whatever growth that they have had cannot be guaranteed by... they can't weather tough times that easily. There's not that much room. 20% is good. It's good enough. If you know the brand and you really like them and you believe that they're going to grow, then 20% is fine. But that is still demonstrative that they're in quite a tough industry, that their gross profit margin is 12% this year. Their financial health is fine. Something funny seems to be happening here. Hopefully that is just profits paying down debt because their equity seems to be going up. That's probably just growth, which is really good to see. Super low debt too. So we're not going to be worrying about bankruptcy with this one, which is a really good thing. So if you invest in this, I wouldn't expect that to be a risk. Oh, Alexa's going off. Price to earnings of 16. So let's have a look at their free cash flow growth. WOSG, Watches of Switzerland Group. Net income compound annual growth rate 5 years is 50%. That's really good. 36%. Free cash flow compound annual growth rate chart 36%. We don't have a 10-year chart. Do we have data beyond 10 years ago? Yes, we do. They were making 151 million in 2018. Okay, so we don't have data older than 2018, so we don't have loads of data to go on here. And it's actually gone down since 2018, and what we've not seen is some sort of massive climb and then a come down, which is a different thing because basically when companies climb lots, then they start spending more money and growing the business. We haven't seen this huge climb at any point from 2018 when this began. to me, this isn't very exciting. But if you know the brand, then this potentially is, because what you've seen is this is a cash generative business that you're not worried about debt. Let's just check that, because I'm worried about that equity chart, but I don't think it's a big deal. I just want to check the shares outstanding. Okay, so they sold a bunch of shares in 2021, or at least a bunch of shares were created in 2021. Oh god, tiny amount. It was 0.03%. So yeah, the shares haven't changed. It's perfectly fine priced. This is a fairly priced stock, but there isn't much, in my opinion, on this stock in terms of margin of safety. I know it says 60% margin of safety there, but what I'm kind of talking about is the margins. For a company that I don't know, I want better margins than 20%, because I want them to be able to lower prices in order to compete if they need to. That's just my buffer. And also it's the demonstration of how quality the product is, that it can charge so much for the cost of goods, for what is spent on the cost of goods. Okay, so that's Watches of Switzerland. Interesting company, but not quite my cup of tea. Southwest. I think this is going to have to be our last one, guys. I was hoping to do PDD. If you want me to do another video, if you want me to talk about PDD, then leave a like and leave a comment so that I know that you want the video. Otherwise, my next video might be on Baidu. Southwest. There's a lot of Southwest stuff in here. I'm going to assume... what could you mean? Probably not Southwestern. Probably Southwest Airlines. To start with, airlines I do not like. Most of them do not have a competitive advantage whatsoever, because basically it's very easy for someone else to do what they do. And some of them have these really solid moats, which is where they own a route from one airport to the other, and basically no other airline is going to bother competing with them. But if you've got good margins, if you're making really good margins on a particular route, then another airline is going to put a second flight. They're going to put a plane on that route and steal some of your margin, basically. So it's one of those things of, and when people are picking flights, the main thing that they pick, because all flights are so similar, is based on price. So airlines are just constantly undercutting each other. Past performance. There is an exception. I do own some EasyJet shares because I think their airline, the business model, the way that they've done it is absolutely genius, but don't have time for that on this video. 21% margin that year. It's pretty good, but obviously they didn't get a lot of earnings out of that margin. All the costs went into expenses. And again, the year before, have they ever had a year of good margin? What the hell happened in 2020? 14%, 34%. So 2017 they had a good year. 36%. Why have the margins shrunk so drastically? That's my question. Also, another issue with airlines is depreciation and amortization. Those planes decrease in value and you've got to update them. So let's just look at past performance and scroll down. Okay, so some big others costs. I'd have to do research on that. And look at that debt. That's so much debt. 8 billion. They're covered, right, with cash and short-term investments, but they have other liabilities as well. I just don't get excited about most airlines, and most airlines don't have something that makes them that attractive or that intriguing to me. So if you'd included some sort of description as to why this stock is so attractive, then I might be interested, but I'm just not that intrigued by it right now. So that is it for this video, guys. If you enjoyed it, leave a like, thumbs up, and feel free to go check out my portfolio on eToro. And if you really want to be rich, you've got to do this.